Good morning. My name is Katie, and I'll be your conference operator today. At this time, I'd like to welcome everyone to the AutoNation third quarter 2021 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question during this time, simply press star followed by 1 on your telephone keypad now. If you'd like to withdraw your question, please press star followed by the number 2. Thank you. I'd now like to turn the call over to Rob Cotaro, Vice President of Investor Relations. You may now begin your conference.
The 2021 conference call and webcast. Please ensure that you're leading our call today will be Mike Jackson, our Chief Executive Officer, and Joe Lower, our Chief Financial Officer. Following their remarks, we will open up the call for questions. I will be available by phone following the call to address any additional questions that you may have. Before we begin, let me read our brief statement regarding forward-looking comments. Certain statements and information on this call, including any statements regarding our anticipated financial results and objectives, constitute forward-looking statements within the meaning of the Federal Private Securities Litigation Reform Act of 1995. Such forward-looking statements involve known and unknown risks that may cause our actual results or performance to differ materially from such forward-looking statements. Additional discussions of factors that could cause our actual results to differ materially are contained in our press release issued earlier today and in our SEC filings, including our most recent annual report on Form 10-K and subsequent quarterly reports on Form 10-Q and current reports on Form 8-K. And now I'll turn the call over to AutoNation's Chief Executive Officer, Mike Jackson.
Good morning, and thank you for joining us. Today, we reported all-time record quarterly results with earnings per share of $5.12, an increase of 115% compared to adjusted EPS of $2.38 last year. This marks AutoNation's 6th consecutive all-time record quarter, driven by strong performance across both variable and fixed operations. Our third quarter same-store revenue of $6.4 billion was up 18% compared to the prior year, as well as the third quarter of 2019. Consumer demand continues to outpace supply, driven by consumer desire for personal transportation and ongoing manufacturer supply chain disruption. We expect this to continue well into 2022. New vehicle sales are currently constrained by reduced production volume, low inventory levels, leading to even more pent-up demand that should support sales for the foreseeable future. In our used vehicle business, our strong self-sourcing capabilities, digital tools, and customer-focused sales processes are a competitive advantage that have allowed us to outperform our peers and the broader used vehicle market. In the third quarter, we self-sourced 90% of our pre-owned vehicle retail sales, and our same-store used vehicle revenue increased 53% year over year. We see additional opportunity to capture used vehicle market share through our AutoNation USA expansion. This week, we opened our 8th AutoNation USA store and our 2nd store in the Denver market, and we expect to open 2 additional stores in Phoenix and Charlotte before year-end. Our rollout schedule remains on track, with 12 additional stores planned for 2022 and over 130 stores by the end of 2026. Today, we announced that we signed an agreement to acquire Priority 1 Automotive Group, adding $420 million in annual revenue. Together with our previously announced acquisition from the Peacock Automotive Group, AutoNation has announced $800 million in annual revenue from acquisitions this year. We also continue to buy back our shares during the third quarter. Over the last 12 months, through the end of the third quarter, we repurchased 27% of our shares outstanding from September 30th last year. Our strong execution and cash flows have positioned us well to continue our disciplined, opportunistic capital allocation strategy. I now turn the call over to Joe Lower, our Chief Financial Officer.
Thank you, Mike, and good morning, everyone. I'm going to start the same place as Mike opened, Today we reported net income of $362 million, or $5.12 per share, versus adjusted net income of $212 million, or $2.38 per share during the third quarter of 2020. This represents our sixth consecutive all-time high quarterly EPS and a 115% increase year over year. As Mike mentioned, consumer demand for personal transportation remains strong, while new vehicle inventory is at historically low levels. In this environment, we continue to focus on optimizing new vehicle margins and procuring used vehicle inventory to support sales. We expect these trends, with demand exceeding supply, to continue well into 2022. For the quarter, same-store variable gross profit increased 42% year over year, driven by an increase in total combined units of 4% and an increase in total variable PVR of $1,709, or 39%. A decline in new units of 11% was more than offset by growth in used units of 20%. Our customer care business has recovered, with same-store customer care gross profit increasing 8% on a year-over-year basis and 6% compared to the third quarter of 2019. Taken together, our same-store total gross profit increased 29% compared to the prior year and 45% compared to the third quarter of 2019. We also continue to deliver significant SG&A leverage due to strong cost discipline and robust vehicle margins. Third quarter SG&A as a percentage of gross profit was 56.9%, a 750 basis point improvement compared to the year-ago period on an adjusted basis. As measured against gross profit on an adjusted basis, our metrics improved across all key categories, with overhead decreasing 390 basis points, compensation decreasing 290 basis points, and advertising decreasing 70 basis points. We expect SG&A as a percentage of gross profit to remain below 60% for the fourth quarter and the full year 2021. Floor plan interest expense decreased to $5 million in the third quarter of 2021 due primarily to lower average floor plan balances. This, combined with a lower effective tax rate and fewer shares outstanding, generated our record EPS. Turning to the balance sheet and liquidity, our cash balance at quarter end was $72 million, which combined with our additional borrowing capacity resulted in total liquidity of approximately $1.8 billion. We continue to leverage our strong balance sheet and robust cash flows to invest in our business. As Mike mentioned, this week we opened our 8th AutoNation USA store in Denver, Colorado. We remain on track to open 2 additional stores in the fourth quarter and 12 more in 2022. As again Mike mentioned, longer term we continue to target over 130 stores by the end of 2026. In addition to organic growth initiatives, today we announced the acquisition of Priority One Automotive Group. We will continue to look for additional acquisitions that complement our portfolio and meet our return thresholds. We have also continued to repurchase our own shares. During the third quarter, we purchased 7.9 million shares for an aggregate purchase price of $879 million. This represents an 11% reduction in shares outstanding for the fourth quarter alone. Today we announced that our board has authorized an additional $1 billion for share repurchase. With this increased authorization, the company has approximately $1.3 billion available for additional share repurchase. As of October 19th, there were approximately 66 million shares outstanding. Despite our significant capital deployment, we maintain ample capacity on our balance sheet. At the end of the third quarter, our covenant leverage ratio of debt to EBITDA was 1.4 times, up slightly from 1.2 at the end of the second quarter, but still well below our historical range of 2.0 to 3.0 debt to EBITDA. We continue to demonstrate strong operational execution and disciplined capital allocation. Going forward, we will remain focused on leveraging our balance sheet and strong cash flows to drive long-term shareholder value. With that, I will turn the call back over to Mike.
Thank you, Joe. It's been my honor to serve in a leadership position of AutoNation for the past 22 years. We've built an exceptional brand, We're America's most admired and respected automotive retailer. We provide a peerless customer experience from coast to coast. And we have made a difference in people's lives with Drive Pink and our efforts to beat cancer. I am forever grateful to all the associates of AutoNation for these achievements and thank them for all their efforts, especially through this pandemic. And I'm thrilled to welcome Mike Manley as the next CEO of AutoNation. He is one of the world's most respected, admired automotive executives, and we are thrilled to have him as our new CEO. And AutoNation has an even brighter future. With this, I'm happy to take your questions.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Your first question comes from the line of John Murphy from Bank of America. John, please go ahead.
Good morning, guys. And Mike, congratulations again on a fantastic long run. It's good to go out on top, although I think the top's going to keep going up. So I think your legacy will be well healed here. And I'd say goodbye, but I'm sure we'll stay in touch. And, you never know when you're going to pop back up again, Mike. So thanks. Thanks for everything. First, question here. You alluded to the supply-demand imbalance lasting well into 2022. I mean, from what we're hearing and modeling, that's going to last at least through the first half of next year and probably well into the second half and maybe even 2023. So you're going to have this high-class issue of high GPUs, presumably continued good performance here, and you're going to generate a boatload of cash. How do you think about cap allocation? I mean, you're turning the tap back on a little bit here, more on acquisitions. You're buying back shares. You're opening AutoNation USA stores. I mean, you're structurally growing the footprint of this company, and it's still being underappreciated by the market. I mean, how do you think about this? I mean, and has anything, changed? And as we, fast forward the clock, I mean, you do simple dumb guy stuff like, say, you bought back 11% of the shares and you acquired revenue of 4% of the company, so 15% higher EPS, go forward just on those cap allocation, very simple, thought process there. But you're going to do a whole lot more of this at least over the next year or so. I mean, is anything changing, and how should we think about that capital being deployed? Because it's pretty aggressive, but not wild at the moment.
John, a few things. So look, I expect more demand than supply well into next year, and as you said, maybe into 2023, but why talk about that today? And we have a tremendous percentage of the income pipeline pre-sold, and I expect as the production distortions and disruptions settle down, they will come in and go out. They're not going to go to inventory. So it's a long journey to more inventory, but I'm in your camp, John. So what? As long as they're coming in and going out. And our strategy of growing revenue by giving customers a choice with pre-owned has obviously been very successful, very compelling. Same time, we've been disciplined on the cost side. And yes, we've viewed, since we're bullish about AutoNation and the outlook, we've viewed share repurchase as an opportunity, which we have seized. And if I go, back over the past 12 months, it's 27% of the shares outstanding have been repurchased. And while we announced $1 billion of board authorization of share repurchase, of course, that's a step-by-step opportunistic decision. And on that forward issue and what it means, what we've done in the past, what it means, Joe, just as a mathematical calculation and how you think about capital going forward.
Thanks, Mike, and thanks.
John, where your point starts with actually having capital, and we have plenty, both from a robust cash flow and a strong balance sheet. As you know, we demonstrated that through the pandemic and prior, and we are the only standalone auto retailer with investment grade rating. So starting there, it comes into
investment prioritization, and really looking at after-tax returns. As we've indicated before, for us, the highest return has been our organic investments into ANUSA. We've laid out a plan. I think we've also been pretty candid in saying so far we've actually exceeded our own plans and very pleased with that progress. Anticipate we'll continue to deploy capital along those lines. We've said throughout that where there are attractive opportunities for M&A, we will pursue them. Year to date, we've announced 2 acquisitions of size, $800 million of revenue acquired, and we'll continue to search and assess and try to identify those that both fit a strategic and financial returns, and then their share repurchase. And, particularly with our outlook combined with relatively attractive valuation given any historical perspective on multiples, we've been extremely opportunistic. And as we've done all that and look forward, we realize we have significant capital deployed, and we'll use the same disciplined and a balanced approach going forward.
Okay, just a quick follow-up on that. I mean, I think it's pretty easy to understand buybacks have an immediate return, acquisitions, relatively quick return. When we think about the AutoNation USA store investment, how fast do you think that return on investment turns positive? Meaning, how fast are these stores now that you're kind of running, not hot yet, but running more normally on store openings? How fast do they become profitable and accretive to the equation? Because I think that's the only part of the equation where there's a lag time on the return of this capital, this massive capital you're generating and redeploying, coming in at sort of at a later date. I mean, how fast is that return?
John, what we want to do is grow the business with the highest return and be in control of our own destiny. So in many ways, the hard part is done. We've built the brand. We have the digital platform. We have the stores, how they operate as delivery centers, speed to market reconditioning centers, acquisition centers. Those are the 3 principal activities that take place within a USA store. We've defined the footprint, that it's highly efficient and effective, exactly what it needs to be. And our speed to profitability has been even better than our plan. And really, the critical path is how quickly we can develop the right sites and build the stores. So every year we expect that to be more than the number that we can build and open to be more than the year before. And as of today, we're declaring 12 for next year. But, Joe, why don't you talk some about the returns?
Yep. So you recall when we rolled out the expansion of ANUSA, we gave a sample model. At that time, we thought break-even would occur within the first 12 months. We're actually realizing that in the first, if not second month. So the success of the model has proven to be very robust. We mentioned that the monthly pre-tax on a full run rate would be up to $200,000 a store per month. We're seeing that being realized much more quickly than originally anticipated. And the investments that we articulated originally in the $10 to $11 million range, even in this environment, we're able to achieve that. So we remain very optimistic. The ANUSA stores in total contributed almost $5 million in pre-tax in the quarter. So again, as Mike mentioned, we're very pleased with the progress. We're exceeding our own plans, and we'll continue to evaluate how to appropriately accelerate that going forward.
And what's important within that, John, is we're now opening USA stores outside the traditional footprint of AutoNation, and that is going extremely well, launching the brand in new markets. So we're very optimistic and confident about the future of AutoNation USA and the returns it will produce, and the fact that we can grow this company, in effect, organically with a brand without paying goodwill. And we control the pace of the growth.
Yeah, it's very exciting. Last question from me on customer care. Momentum seems to be building. Obviously, because of the shortage of inventory, people are holding on to their cars longer and driving more. So, I mean, I think there's been an expectation that, as the economy reopens, people drive more, you'll get a bump. But there hasn't been sort of that second thought process of, people are holding their cars longer, so they're willing to do more maintenance or need to do more maintenance, not even willing, but need to do more maintenance. I mean, how do we think about those, two factors benefiting same-store sales on customer care, and are we still at the early edge of the reacceleration there?
Well, we clearly have seen reacceleration with us now, right, exceeding 2019. The strong areas, obviously being areas of customer pay, have continued to perform well versus both 2020 and 2019. The one area that continues to be just a little bit of a laggard is collision. We do anticipate as miles continue to improve that will fully recover. But overall, we're very pleased with the progress we're seeing in the business. And despite concerns about part shortages, continuing to demonstrate growth over both 19 and 2020. So we're cautiously optimistic that we'll continue to see those trends improve as we kind of proceed through this year and continue to kind of see people increasingly return to the roads.
Great. Thank you very much, guys. Appreciate it.
Great, John. Thanks.
Thank you.
Your next question comes from Rajat Gupta from JP Morgan. Please go ahead.
Great. Thanks for taking the questions. And Mike, I just wanted to echo John's comments as well. Congrats on a great career and best of luck going forward. Just had a couple of questions. You're just starting with F&I. Really strong numbers here in the third quarter. Despite of the lower mix of new vehicles versus used. I'm sure ASPs had a benefit there, but just curious if there's anything else that's going on there, maybe penetration for some new products that's driving that number, and just curious as to how we should think about the sustainability of that. And I just have one follow-up on SG&A here.
Thanks, Rajat. I'll answer that. So first of all, your assumptions and observations are correct as far as the relative F&I or CSS, as we call it, between new and used. But the real driver for us has been increased penetration. And as we continue to see that improve, it obviously impacts whether it's new or used, which has resulted, again, in very favorable trends pretty consistently over the last several quarters. And our expectation is that will continue. The pace of improvement, we'll obviously watch closely, but we don't see any significant threats to what we're doing in that part of the marketplace, just given the fact that it really is driven by penetration rather than other factors.
Got it. And the penetration, is that across both finance and service contracts? Is one versus the other driving that? Just trying to think like which part of that might be more longer term. Finance maybe is benefiting from like just the higher ASPs and lower rates, I guess, because the monthly payments are optimized. But I'm just curious if the service contracts.
It's more product, or if you want to call it service. It's really more driven by that. As I think about 2/3 of F&I for us comes out of product versus financing, and we continue to see that area grow in the number of products and the number of customers that we're penetrating. And so it's much more of that than it is a financing or rates issue.
Got it. And just on SG&A, you've given some good color to us in the past around like the sensitivity there and what your medium-term targets are. But how should we think about given like productivity continues to get better every quarter? Is there any change to how you're thinking about that ratio longer term, or maybe like just making changes in your incentive model within the store that could also lead to a more structural change to that number? F&I is looking much higher than before. That has more leverage. So just curious, any updated thoughts there, and if we can get any updated sensitivities around SG&A to gross versus just GPUs once you're back to a more normal supply demand environment. Thanks.
Yeah, sure. The way I think about it, we always talk about the three buckets. We talk about compensation, we talk about advertising, we talk about store and corporate overhead. As I look at those items, let's start with store and corporate overhead. From a dollar standpoint, flat year over year. So obviously maintaining that discipline through the increased activity of the business is very important. I anticipate that we'll continue to maintain that strong discipline within the store and corporate overhead line. Advertising, modest increase in total dollars year over year, in part driven by rates. But again, very modest. We'll continue to watch that closely. That also improved, though, as a percentage of gross. And then you get the comp. And, compensation increased about $83 million. $81 million of that was variable comp in the stores, which candidly is the model you want, which is obviously record gross profit that's being generated in the stores, and that's going to translate into the compensation. And obviously that will vary, as does profitability. So I feel like we are maintaining the discipline we need, despite always looking for ways to continue to drive out cost, and acknowledge that variable comp will fluctuate, as it should, with a model that really is predicated upon production. And so that's kind of why I think about the model and why I feel pretty good about where we are and why I feel confident as I look out the next couple of quarters, seeing the success we're having in maintaining the discipline on controllable cost and recognizing the only real fluctuations are variable associated with compensation in the stores.
Got it. But there's no change to just long-term the SG&A to gross level. You indicated 65, 66%. So just that's still pretty much on track, right? For a normalized number.
Yeah, it's going to be a long-term thing, but I clearly think we've demonstrated that we can operate the business at a lower relative cost than was done historically, in large part by the deployment of digital tools that are making our sales and service associates far more effective. And that's translating, into the fact that we've been able to continue to operate with, 3,000 plus fewer heads within the store environment on a same-store basis year over year.
Understood. Great. Thanks for all the color, and I'll get back in the queue.